Happy Friday. It is Friday, February 27th, 2026.
A very weird Friday, I think it's fair to say.
Yeah, weird doesn't even begin to cover it. If you're tuning in for your daily Bitcoin briefing expecting us to just look at the red candles on the chart and commiserate, well, we are going to do a little bit of that.
Just a little.
But we have something much, much stranger to get into today. It's really a study in contradictions.
Right, because on one hand, the price action feels like a roller coaster rejection.
Completely broken. We hit a brick wall.
But then you look under the hood at the plumbing of the financial system, and the biggest institutions in the world are permanently welding themselves to the asset class.
It's a massive divergence. So in this deep dive, we're going to cover that fake rally, why 70,000 became this impenetrable wall.
And we've got the winner-take-all ETF war. BlackRock is basically swallowing the market.
Swallowing it whole while everyone else bleeds. Plus, we're looking at Morgan Stanley and Crypto.com making these massive infrastructure plays, practically becoming banks.
Or actually becoming banks.
Exactly. And the utility shift, right? Magic Eden abandoning Bitcoin NFTs while the New York Stock Exchange is moving to tokenize the actual stock market.
The contrast there is just incredible.
It really is. And stick around for the end, because we're looking at a story out of ETH Denver that involves a quantum computing threat and a proposal to literally burn Satoshi Nakamoto's coins.
It sounds like science fiction, but it's a very real debate.
Yeah. So let's jump right in. We have to start with the market microstructure because that $70,000 trap is the pain point this morning.
It was a brutal rejection.
Thursday morning felt incredible, right?
Yeah.
We had NVIDIA crushing earnings, throwing this massive risk-on sentiment into the market.
Yeah, the S&P was flying.
And Bitcoin established this really solid-looking baseline right near $68,000. It felt like we were coiling for a breakout.
It certainly looked that way on the surface, but if you were watching the order book, specifically the level 2 data, the structural integrity of that move up was basically non-existent.
So what actually happened when we hit 70,000?
Yeah. We slammed into a supply wall. It wasn't just a psychological barrier for retail traders. We're talking about a dense concentration of institutional limit sell orders sitting right at that exact threshold.
So big players had already decided, if it hit 70K, we're dumping.
Precisely. They offloaded enough inventory to just completely absorb every single dollar of buy-side pressure coming from the retail side.
A liquidity trap.
Exactly. And the key technical failure here happened right after. Bitcoin failed to hold the 200-week exponential moving average.
Which was sitting at, what, 68,300?
Yeah, 68,300. That specific moving average is what algorithmic trading desks use to define the macro trend.
So if you fall below it,
the machines switch to bear mode. They read that previous rise as a counter-trend relief rally, not a macro reversal.
And once that short squeeze exhausted itself, the floor just fell out. We crashed to an intraday trough of around $65,826 by this morning.
Which confirms what we've been seeing. This market is currently dominated by mean-reverting algorithms.
So institutions basically use the NVIDIA news as exit liquidity.
That's exactly it. They use the hype to offload their bags onto retail buyers who thought the bull run was restarting.
Man, that is brutal. But here's the part that's really confusing. If you look at the ETF headlines from yesterday, they look fantastic.
The net inflows.
Yeah, $254 million in net inflows on February 26th. Over $1 billion in just 3 days. How does that square with a massive sell-off?
Well, this is where you have to be really careful with headline numbers. That $254 million is technically accurate, but it's an optical illusion.
How is $250 million an illusion?
Because of the winner-take-all dynamic. If you break down those flows, the entirety of that positive flow, specifically $275.82 million, went to exactly one fund.
BlackRock's iShares. IBIT.
Only BlackRock.
But wait, what about the others? Fidelity, ARK?
Capital flight. Competitors like Fidelity's FBTC and ARK's ARKB actually saw net outflows on that exact same day.
So they were bleeding capital while BlackRock was vacuuming it all up.
Right, and this represents a structural maturation of the market. Institutional allocators aren't spreading their bets around anymore.
They're just going with the biggest name.
Consolidating into the fund with the deepest liquidity and the biggest brand, it's rapidly becoming a BlackRock monopoly.
Which is wild when you think about crypto's whole ethos of decentralization. And speaking of centralization, the institutions aren't just buying the ETFs anymore. They're bringing the actual infrastructure in-house.
The adults in the room are taking over the plumbing.
Yeah, let's look at the news out of the Enterprise Bitcoin Conference. Morgan Stanley is apparently building proprietary, in-house custody and trading architecture.
They are firing the third-party middlemen, no more relying on the external custodians to hold the keys.
Which is a huge pivot. Custody is incredibly risky. Why take that on?
Well, two reasons. First, they want to capture all the fees. But the real game changer is yield. They want to offer lending and yield products directly.
And this introduces the magic word of traditional finance, rehypothecation.
Exactly. Rehypothecation. They're taking inert cold storage Bitcoin just sitting safely on the blockchain and turning it into active financial collateral on Wall Street ledgers.
So if I hold my Bitcoin at Morgan Stanley, they might lend it out to someone else? It's fractional reserve crypto.
It is. It's institutional enclosure.
But then you look at the other side of the spectrum, crypto.com. They are an exchange, but they're basically becoming a bank.
Right, operating as forest stacks. They just received a National Trust Bank charter from the OCC.
The Office of the Comptroller of the Currency, that's a massive regulatory stamp of approval.
It's huge. It means they can operate uniformly across all 50 states with federal supervision.
So instead of fighting regulators state by state, they're just getting absorbed into the federal banking system.
Which signals that regulators aren't trying to ban these entities anymore. They are integrating them.
Okay, so the suits are moving in, the infrastructure is getting locked down. But what about the native crypto utility? This brings us to Magic Eden.
A devastating blow for the digital collectible side of Bitcoin.
Devastating. Magic Eden is shutting down its Bitcoin marketplace in March and then dropping wallet support entirely in April. They're pivoting to focus on Solana.
And context is everything here. Magic Eden had an 80% market share of the Ordinals and Runes ecosystem.
80%. If the dominant player just picks up and leaves,
It means the economic model of trading JPEGs on Bitcoin has collapsed.
the volume just dried up.
Right. And the real impact here is on the miners. They relied heavily on the fee revenue from all that inscription volume. Without it, their margins get even tighter.
So the fun, experimental JPEG phase on Bitcoin is dying. But ironically, traditional finance is picking up that exact same blockchain technology for serious use cases.
The utility swap.
Exactly. Look at the New York Stock Exchange. The actual NYSE is launching a blockchain-powered platform for 247 trading of tokenized equities.
Ending the T+1 settlement delays.
Instant settlement for the stock market. And Grant Cardone's firm, Cardone Capital, they're tokenizing a $5 billion real estate portfolio to make illiquid property tradable around the clock.
And WisdomTree secured SEC relief to trade their tokenized money market fund, WTGXX, 24/7.
Using USDC as a settlement rail.
Right. The market is aggressively rejecting digital collectibles on Bitcoin, but it is entirely embracing blockchain as the permanent plumbing for the global financial system.
It's growing up. But we can't talk about growing up without looking at the politics, which are currently a mess.
A total circus.
We have the Clarity Act, a piece of legislation trying to provide regulatory frameworks. And then Sam Bankman-Fried, sitting in prison, releases a statement endorsing the bill and claiming credit for it.
It's the most toxic endorsement you could possibly ask for.
Senator Loomis, who sponsored it, immediately rejected his support. But Senator Warren jumped right on it to attack the bill, saying an SBF endorsement should ring alarm bells.
Of course she did. It's perfect political ammunition.
So now the bill is completely stalled because of the optics. SBF is still managing to tank crypto markets from behind bars.
The optics are terrible, but we also have to look at the macro data, which is quietly keeping the price suppressed. The boring but important numbers.
Right, the labor and inflation data we got. Jobless claims came in at 212,000. Stable.
Very stable, which means the labor market is strong.
Yeah.
But then the producer price index, the PPI, came in hot at 0.5%.
Expectations were 0.3, right?
Right. So we have sticky inflation and a strong jobs market.
Meaning the Fed is not going to cut rates anytime soon.
Exactly. And because of that, the DXY is strengthening. When the dollar is strong and liquidity is tight, Bitcoin becomes very expensive to buy.
The macroeconomic trap.
Yeah.
Okay, we've covered the macro, the ETFs, the banks. Now we have to talk about the existential threat. The panel from ETH Denver.
This is the part that keeps people awake at night.
Google's new quantum chip, Willow. The fear isn't that Google is going to hack Bitcoin. The fear is state-sponsored intelligence agencies.
Right. Using quantum computing to crack ECDSA encryption, the cryptography that secures the wallets.
So they could theoretically derive a private key just by looking at the public key.
Specifically for lost coins that sit in old legacy addresses.
Like Satoshi Nakamoto's stash.
Exactly. Those early blocks used a different public key format that is highly vulnerable to quantum attacks. Satoshi has roughly 1 million coins sitting there.
Over $60 billion just waiting to be cracked. So if a nation-state gets a powerful enough quantum computer, they could steal it all.
And crash the market completely. So developer Matt Corallo put forward a highly controversial fix.
A social consensus event.
Right. A mandate where everyone has to move their coins to new quantum-resistant addresses.
But what about the lost coins? What about Satoshi, who isn't around to move them?
Corallo suggested that any inactive or lost coins that don't move by the deadline would have to be burned.
Burned. So we literally destroy Satoshi's coins to prevent them from being stolen.
That's the proposal.
But that violates the absolute core tenet of Bitcoin: immutability. The whole point is that nobody can confiscate or destroy your property.
It's a massive crisis of philosophy versus survival. If you don't burn them, a state actor steals them and destroys the network's credibility. If you do burn them, you admit that the network's rules can be changed to confiscate funds.
And given what we just talked about Morgan Stanley, BlackRock, the NYSE taking over the ecosystem, do you think they care about philosophical immutability?
They care about protecting their multi-billion-dollar ETF assets. They will absolutely advocate for burning the vulnerable coins if it secures the network.
Wow. So institutions are building this impenetrable fortress around the asset. The fun, experimental phase is dying out. The price is trapped by sticky inflation, and the ultimate solution to secure the network's future might require destroying its founding principles.
It's a heavy Friday.
It really is. So we'll leave you with a provocative thought to mull over this weekend. If we have to burn Satoshi's coins to save the network from quantum hackers, and if the rest of the available supply is locked up in Morgan Stanley's rehypothecation vaults and BlackRock's ETFs, have we actually saved Bitcoin?
Or have we just created a slightly faster, tokenized version of the exact same banking system we already had?
That's the multi-trillion-dollar question. We'll leave you to think on that. Thanks for joining us for the Daily Briefing. We'll be back on Monday.
Take care, everyone.